Well, hey there, and welcome to another edition of Retire Smarter. Walter Storholt here alongside Kevin Kroski of True Wealth Design. He's the president and wealth advisor there, serving you throughout the greater Pittsburgh area, Southwest Florida, and of course, the home base, Northeast Ohio. You can also find us online from anywhere at truewealthdesign.com. Folks, get ready for it. Unfortunately, he does not have the golden pipes today. But he is. The show must go on, Kevin. You're embodying that showbiz spirit. I'm proud of you.
There you go. And I don't know if I've ever had the golden pipes. What's the old saying that maybe a little self-deprecating humor? Maybe I have the face for radio or face for podcasting, but certainly not the golden pipes.
There you go. There you go.
In fact, my kids are still at the age where they don't know that they inherited daddy's voice, so they sing, and it's like the cutest but most awful sounding thing in the world, and it's all my fault.
They'll be able to get away with it for a few more years, and then they'll start realizing, I don't have the gift, maybe.
Yeah, maybe. It'll be a sad day for sure in the Kroski household. But
I used to be part of what we called the frog choir, Kevin, which was it didn't matter what your voice sounded like. It was the passion behind the music. That was what was important. So it was a choir made up of all guys who are terrible at singing. So all we were really going for was heart, passion, and volume. Those were our strengths.
The frog choir?
The frog choir is what it was called, yeah.
I might have to tuck that in the back pocket and bring it out from time to time, Walter.
Yeah, I have the good radio voice, but it did not translate to music, unfortunately.
Well, very good. Well, I'm not sure how to make the nice segue here, but working a frog somehow, but maybe the markets have been kind of having like a frog in the throat over the last several months. And
there it is.
There we go. I pulled that out, some way, shape, or form. But today I don't really have much prepared, but I know a lot of people are probably looking at their portfolios and wondering what the heck is going on. Stocks are down, bonds are down, and they're really not understanding and they're concerned. So I thought it would probably be worthwhile for everybody just to go ahead and kind of talk through what's been going on, as well as, having some reasonable expectations and what certain purposes of investments are in your portfolio, and really touch on diversification as well. I think, and Dr. Finca, who we had on recently, kind of touched on this, but one of the things that he said in closing, a bit of a pessimistic but probably a realistic tone, was just a lot of bad news for retirees in terms of low expected returns, some inflation that we've been having, and that's really come to manifest just over the last several weeks. And we've seen that in the investment market. So I thought that's what we just kind of riff on that today and tackle it. And if I get too far down the rabbit hole or start using too many numbers or kind of acronyms, you can go ahead and hit the nerd alert or
the good old egghead alert. I'll get it queued up. I'll get it ready to go. Yeah.
But more importantly, bring me back and don't let me go down there too far. Okay.
Fantastic. Well, I'm sitting here with my hand raised, Kevin, as someone who's, just in all honesty, somebody who's looking at the market and feeling a little, despite all the calmness that you present on the show and the education you provide, that emotional bone is taking over a little bit. And yeah, I feel nervous. I feel the effects of the roller coaster up and down. So I'm looking forward to your calming guidance on the show today.
Well, that means you're a human, Walter.
Well, that's a good thing, right?
Yes. Quickest. I mean, we all are, I guess, I don't want to say varying degrees. We're all, are unique snowflakes, right? And I used to say that all the time, but now snowflake has some other connotation than
you said it before it got all twisted into something else.
Yeah, darn it. They stole my word. But candidly, one of the things that makes a really good investor, probably also makes a good psychopath, is lack of empathy, when you can really just be very rational and thinking through things. There's been a lot of different neuroscience brain studies that have showed this to be the case. In fact, probably my favorite, and this isn't necessarily tied to empathy, but the amygdala, the real part of your brain that is, kind of, the lesser developed, if you will. It was the fight or flight mechanism. It can't distinguish between a bear market or a bear in the woods. The latter of the two is probably more risky to your existence. But there was a study, I think it was like 2005. I'm going from memory here, but it was like out of University of California in Davis, and they studied people with damage to their amygdala and put them through a series of stimulus response type questions around investing. And the conclusion was that the people with brain damage were actually better investors than healthy brain people, because they weren't as emotional, because they weren't as
fascinating, absolutely fascinating.
Yeah, I mean, and so it's, and then I'll kind of set this up to the next episode we're going to do. I'm going to have, my partner Tyler Emmerich on, and we're going to talk about some of these, I don't want to say tricks that our brain plays on us. I mean, they tend to work really well in many areas of our lives, but when it comes to investing, they can actually tend to cause harm. So it doesn't mean that our brains aren't working properly or what have you, but there are some tricks or shortcuts that the brain uses that's very, very useful in other areas of our life that don't, work so well when it comes to investing. So it's kind of where we're going to go to, in the next episode, but it'll have some play into today too. So we have this, and even before we kind of get into, I guess, the returns and diversification and all that jazz, let's not lose sight of the purpose of all this. Obviously nobody likes to see their accounts go down, but as we've talked about and practically preached on the podcast over the years, really, what's the purpose of the money? The purpose of the money is not just to see how many dollars that you can accumulate. It's to make sure that your lifestyle is being able to be maintained and preserved over time. When you do go ahead and turn off your paycheck, and what you've accumulated has to last the rest of your lifetime. And we don't know how long that is, and we don't know what inflation is going to be. And yes, the future is uncertain, but step number one is have your money last at least a little bit longer than you do. We have our Retire Smarter solution that we go through that 6-step process that really kind of compartmentalizes these, and I think helps people understand really what's required to have a good plan in place to make sure that their goals are met, that their lifestyle is preserved, and we're making smart decisions. I think it's episode 45 if you want to go back and take a listen to it. But the investments, the point being is they're not looked at in isolation. They're looked at in relative to your lifestyle, relative to your financial life plan. Your investments need to be stress tested against that life plan. You need to measure your required return. How much, do you really need to produce to go ahead and make sure that you have a high probability of meeting, your goals and maintaining your lifestyle and what have you. That you need to measure your capacity for risk. How much risk can you legitimately afford to take? A lot of clients can take quite a bit. But then the third variable there is they may not feel comfortable with it. And we call that risk tolerance. So that's more the emotional side of risk taking. All of those are very, very important. So even though we're going to talk about investments today, I don't want to lose sight that first step that I just highlighted is really where you need to start and is really, really important. And as I mentioned, when we had Dr. Finca on the podcast, and thanks again to Dr. Finca, I'm sure he's not going to listen to this, but I had a lot of people reach out to me. We seem to have a lot of advisors that actually listen to the podcast and have positively shared that they've actually picked up a lot of things that they've used to help clients. So it's been kind of a pretty cool thing. And a lot of them hadn't heard of Dr. Finca and actually got a lot of good takeaways from that. Had several clients actually told me it was one of their favorite episodes, a favorite series. So that was really, really great feedback to hear. But as I mentioned, he talked about, the low return expectations. Really, the way he phrased it was the bad news for retirees today. People, not that they've been retired for maybe 10 years, people that have been retired for 10 years have had really, really good returns over the last 10 years. They've had low inflation. They've kind of made it through a sort of a retirement red zone where, those first few years leading up to and into retirement tend to be the most risky and largely determine the success or failure of your retirement plan. So what he's talking about is really the people that are kind of, in that retirement red zone today, the people that are, nearly approaching or just getting into retirement. And he's saying for those people that, really the news is pretty bad. And for those reasons I said, the markets are generally expensive, whether it's the bond markets, the stock markets, or the real estate markets. All markets are pretty well expensive. Sure, we've enjoyed quite high returns, but a lot of those positive returns have arguably been kind of pushed forward over the preceding years and really are going to take away from what we can expect going forward. We talked about inflation, and it's not just inflation there, but it's really, and this is something we're going to get into today, it's really changing expectations. So it's not that, hey, inflation is 2 or 3 or 7%, but it's really when those expectations of like, hey, we're expecting maybe 3%, 2%, but now we're getting something much higher than that. Or, hey, we think, inflation is transitory due to COVID, but, we have ongoing supply chain issues. We have, truly some persistent inflation. We have, worker shortages. We don't have immigration. China's in lockdown, impacting the supply chain. We have Russia invading Ukraine, roiling energy markets, you name it. There's a lot of things that have happened that, we had expectations, but they've changed quite a bit. And we've seen that royally impact stock and bond markets over the last several months. So those are kind of setting the stage to what we've seen here so far this year. But I just pulled up a quick list of some broad index returns. So these aren't, actual investment returns. Indexes don't have fees, all the common disclosures there. But if we just look at year to date, and, here we record this on May 11th. And so these are returns through May 10th. So year to date, 2022, the Russell 3000 growth. So these are more growthy assets. We've done a lot of episodes over the last couple of years about how these growth assets are destined to underperform. They had really strong returns, but they were candidly trading at nosebleed valuation levels that just couldn't really be justified. Somewhat similar to what we experienced in the 1990s with technology stocks. And nobody can predict the timing when these things are going to happen, but it often tends to be pretty swift, and that's what we've seen. So the Russell 3000 growth is down, 24%. The NASDAQ's down actually a little bit more than that. If you just look at the S&P 500, so now the S&P 500 is still fairly growthy. I won't get into the reasons why, but it's kind of changed composition due to what's transpired over the last decade or so. But that's down nearly 16%. Russell 3000 value. So now here we go to the other side of growth. So these tend to be cheaper stocks, tend to be slower growth. They may have a little bit more debt on their balance sheet, things along those lines. It's only down 9%. So quite a big disparity there between the growth and the value, about 15% difference between the two. And here's the one that also is getting people, hey, what about my bonds? What about the thing that's supposed to be, the safe part of my portfolio? Well, if you look at just the U.S. aggregate bond index, so the Bloomberg Barclays U.S. Ag Bond, it's down just about 10% year to date. So Walter, I'm looking at this here, and granted I'm a little under the weather, but I didn't see any positive numbers there. Did I miss something?
I heard a lot of negatives in there.
A lot of
I'm picturing lots of minus signs.
Yeah. So this comes back to the idea of diversification, and most people, particularly when they start working with us, they generally will have the majority in U.S. stocks. People, not just in the U.S., but around the world, has something what's called a home country bias. We tend to prefer the things that we're more familiar with. We tend to prefer those things that we're around, whether we drive, by Walmart or McDonald's or Amazon or whatever the case may be. We tend to own more of those things that we're familiar with. It just comes back down to that behavioral aspect of our brains.
Is that necessarily a bad thing? Because I'm just going to take like an everyday example, like Shark Tank. They say all the time, like, hey, this looks like it might be a great investment, but I just don't know this space, so it's not right for me. I'm out. Now, that's a little bit more complex, as they're actually talking about helping to run the business in that space. So I realize there's more context there, but it seems like that's championed as like a good decision to invest in what you know.
Yeah, there's a really big difference here. It's a good point that you're making, and there's a really big difference here. And here's how I'll take a quick tangent, and this is something really important to keep in mind. And I think a lot of business owners suffer from this too, because if you look at the people that have created the most wealth in our country and around the world, it tends to be, business owners, somebody that had a lot of concentration, that maybe had some luck. I'm sure they worked really hard, and they created, a successful business and probably a significant amount of wealth for them. And that's how they created it. But how they created it and how they preserve it are generally, two different things. What you're talking about and what the Shark Tank people are talking about is, buying an individual business, is operating an individual business. What we're talking about is really diversifying and not taking any specific business risk, but taking market risk. And those are two different types of risks. You can own a whole group of stocks, whether it's the S&P 500 or many others, and you can diversify any specific. And I'll give you the egghead alert here. Dr. Finca would call this idiosyncratic risk, but basically that is.
Yeah, that triggered it. That did it.
Egghead alert.
All right. It's been a while since I heard it.
Idiosyncratic risk.
Did you just actually start slipping and call it idiot-syncratic risk?
I might have.
That's
the alternate spelling.
That might work pretty well, but you don't get compensated from taking risk in an individual company. There may be a luck factor, and may create significant wealth. But the reverse may be also true, and many people have seen that over time. But it's just very different. I mean, we're talking about kind of apples and oranges, truly, particularly for people that are in retirement or close to it, and we're talking about making sure that their money's going to last their lifetime. Probably one of the worst things that you can do is really, take a lot of concentrated bets. Certainly, it could work out, but the probabilities are not in your favor, and you could really end up losing the war on the last battle, which makes zero sense. So yeah, it's a great question, but it's kind of diversifiable and non-diversifiable risk. If you're going to take a market risk, broadly speaking, that's non-diversifiable, and generally speaking, risk and return are related. So if we're taking market risk, we expect to be compensated for that. Otherwise, why would we take the risk? We would just own bonds or cash or whatever the case may be.
I knew you'd set me straight. Yeah, I appreciate that. So thank you for the tangent.
Yeah, it's a great question. I mean, candidly, and I'll mention this too. I went through quickly through the different returns. We've been in this, and this will kind of get into the next. This would be a good transition anyway, but we've been in this period of kind of low inflation expectations and high growth over the last several years. I've mentioned many times about how these high growth assets, yes, they've done well, but candidly, it's not, and some companies certainly have grown their earnings and grown their earnings per share, and that's been a net contributor. But if you look at it in general, it's really been a behavioral thing where people just have bid up the price. So rather than paying, $20, for every dollar of earnings for the company, they said, no, thank you. We think it's worth 30 or 35 or 40. And they just really bid up the prices of these stocks. And it happens time and again. And it's just how people are, unfortunately. It's the sort of a euphoria that they have. There's a crowding behavior. They have this FOMO of missing out, and then they just start kind of chasing on and driving up the price further until the music runs out. And the music certainly has run out over the last several months, and we'll see, what the future holds beyond this. But if you look at some of the real high flying, names over the last several years, over the last decade, but particularly over the last several years too, all the FANG stocks we've talked about, you're down much more than that kind of broad growth index that I talked about. There's one that I particularly like to pick on. It's kind of the poster child of this whole era. It's a exchange traded fund. It's the ARKK Innovation ETF, and it's like mostly Tesla, Coinbase, like a few other kind of high flying companies that have very low earnings and very high multiples that people are paying, and that the ticker symbol, if anybody wants to take a look at it, is ARKK. And unfortunately, it's been so commonplace that we've seen this in portfolios, for people that we're starting to work with, and they've just completely chased these returns on the way up. And the returns, really the most flows into the fund, and this happens time and again. This isn't just ARK, but any sort of exuberant period like this, you see this happen. People they use that hindsight to go ahead and pick this fund. They say, wow, look at this fund has had like really high returns over the last 3 years. I should go ahead and invest now. And then they kind of pile on as the price is already high. So the price has already run up on these things. Most of the flows for ARK came in starting in December 20, January 21. The fund reached its peak in February 2021. It's down more than 70%, from that high in February 21 to where we are today. And it's down more than 50% in 2021. So all those people, if you look at the 5-year returns for ARK, it doesn't look all that bad. Certainly relative to risk, it's not all that favorable in my view. But the thing is, those are what's called kind of the time-weighted returns, whether you go on Morningstar and you see that reported, or Yahoo Finance, or wherever the case may be that you're getting information. But the actual money-weighted or dollar-weighted returns that people are getting are way, way less than that, because they bought in at the high, and now they bought in, probably somewhere around the high water mark, when all, say, hey, look at this fund, we're a 5-star fund, this time is different, don't invest that old way, invest this way. And then they bought, kind of crowded in. And now they're down probably 50, 60, 70%. And unfortunately, I think of a new client that we have, and literally like all of their money is in this large growth bucket. ARK is in there, and, we're working with them, like, candidly, we didn't explicitly say this, but we look at this like, wow, this is crazy. It was my initial reaction. This is not rational, is maybe a more fair way, or the way that we would speak to somebody about this. But, they're down like 30% year to date, and they're freaking out and say, this is why. This is exactly why. You chased it on the way up. You bought it when it was already high. Now the music ran out. Now the market is down, and now you're scrambling saying, oh crap, what do I do now? And it's unfortunate. Certainly we wish we would have been able to kind of meet this person before that they made these decisions, but there's no time like the present to be prudent. So it kind of is what it is, unfortunately. Or the old adage of Wall Street charges high tuition, unfortunately comes to ringing in my mind as well. So that's been the environment that we've been in. We've been in kind of this high growth, low expected inflation. You had things like growth stocks doing really well, corporate bonds doing really well, and just U.S. stocks in general and developed stocks in general have done really well. That's been kind of this predominant regime that we've had over the last decade or so. And that's where most people's assets are. Walt, you've heard of the traditional 60-40, I bet?
Yeah, the 60-40 portfolio.
So what's the 60-40 as you understand
60 stocks and 40 bonds, percentage-wise?
You got it. And if you look over, and that's pretty common, and literally it's not just people, but literally like institutions, endowments, pension funds, historically had risks similar to that. It's kind of evolved from that over the last decade or two, but it's kind of a good starting point, if you will. It's fairly common. Most people know it just as you do. And it had its best risk-adjusted returns, really over the prior 10-year period, ending last year. So we've been in this regime where, interest rates were declining, growth was going well, all these stocks were just kind of, people were bidding up the multiples, bonds did well, and now it just changed, and it changed quickly. And there's two kind of key variables that I would think about when you're kind of thinking through this. And it's really kind of unexpected inflation changes. So, and again, here's that unexpected word. It's not just if we have inflation, it's really the change in expectations. It gets a little wonky to think about. And then the other one is kind of changes to growth, whether we have, higher than expected growth or lower than expected growth. And if you kind of plot those out, think of like a little map, you kind of come up with like a 4 quadrants where, you can have high unexpected inflation and low unexpected growth, so on and so forth. So what I mentioned is like really that prior 10-year period or so, really since the financial crisis, we've had that low expected inflation, high growth, and growth stocks, corporate bonds, all really developed market equities have done really, really well. And this is where most of the people have most of their assets. And that traditional 60-40 stock bond, even though you have 40% in bonds. Here, I'll ask you a question, Walt, and I don't expect you to know this, but I think you might be able to make a good educated guess.
Okay. How
much of the risk in the portfolio, the traditional 60% stock, 40% bond, comes from stocks?
60% of it?
Here's the thing, and that's a good guess. I mean, because it seems like what you would think, right? That seems logical. Well, I got 60% in stocks and 40% in bonds. But here's the thing. One, stocks in general have leverage. Companies borrow. So on average, if you look at the S&P 500, there's kind of like a 2-to-1 leverage ratio that they have there. So if stocks were so there's automatic, anytime you have leverage, you're going to have more kind of volatility there. And stocks are inherently more volatile than bonds to begin with. So because they're more volatile than bonds, when you actually decompose the risk factors, literally about 90% of the risk in that traditional 60-40 stock bond comes from stocks, 90%. It's just because of that volatility difference that I just described.
So the 60-40 mentality of being the split of risk is really a misnomer, or really quite a piece of misinformation, I guess.
Yeah, it completely is. The 60-40 on a risk level is really 90-10, stock and bond. So in terms of risk, in terms of defining it by volatility. So if stocks are down a lot and bonds are kind of holding their value, that may be fine. But, because 90% is coming from stocks, it's still going to dominate the portfolio, and then obviously we have times like we're in right now, and we'll see if it continues. But we've seemed to gone through like a few of these different quadrants, quite quickly. We went from the period that we've been in. Actually, it seems like we've kind of gone through all four really in the last couple of years, which is a little bit unique. But low expected inflation, low growth. So whenever COVID happened and the whole world shut down, we had inflation expectations drop through the floor, growth expectations drop through the floor. It was a shock. These are also things not just like COVID, but, the Great Depression, financial crisis, the tech wreck. When things just go really, really bad, really the only thing that does well in those environments are government bonds. So while, we've had this period that we're coming out of, and, growth stocks did well, corporate bonds did well, real estate did pretty well, even value stocks did fairly well. All developed market equities did good. When COVID happened, or those other big severe events that I just mentioned, it's really only government bonds that kind of, shoulder the weight there. Everything else kind of, you may have heard the phrase, all risks go to one and everything else just kind of drops together. Government bonds are really been the only historical solace in that environment. So we had that in March of 2020. Then we kind of got through that. The Fed came in and just kind of, went with their bazookas and started kind of quote unquote printing money. And we had also fiscal stimulus with checks being sent out to people, both here domestically and global central banks around the world. We got back into this kind of, high growth. We had low inflation expectations. And then really we're kind of just more recently got into this, high unexpected inflation, and we still had, fairly high growth. So I would say that's been kind of more typical that we've seen over some months where, real estate was still doing fairly well. Commodities, have done pretty well. Even some emerging market bonds and stocks do fairly well in that environment. But, that was probably a period, if you think more so like the 2000s, you kind of post the tech wreck and before the financial crisis, I would say that was more emblematic of that period than any. And now, more recently too, we've had some, we were still growing well, but the markets seem to be more concerned about inflation. But now, at least over the last, couple weeks, as stocks have sold off, quite a bit, and bonds have actually started doing well again. We've had more concerns about growth. So the markets have become more volatile in general in regards to these expectations. And I think that's probably something that is likely to continue for a while. But, in those periods, like we've had more recently, commodities have done well. Gold's done fairly well. This is kind of more like the 1970s, kind of that stagflation period, at least in some ways, to what we're experiencing more recently. But those are some of the assets that kind of do well in those different environments. And I think that's important enough to know. Again, most people, when you look at their risk, say if they do have the traditional 60-40, 90% of the risk is coming from stocks. And if you actually look into what they actually own, it's really going to be assets that typically only do well in that one regime, generally speaking, of the period that we just came out of, kind of the high growth and low inflation. Let me pause for a moment. I know it's been kind of rambling on here, but Walt, bring me back down, buddy. Making sense? Any questions you got?
No, you're making sense. I'm along for the ride today. I'm enjoying the perspective. It does feel good to take a breath, though, so this will be good. Gather those thoughts. You were steamrolling for a while in a good way, which I liked. So, no, keep it going, because I think this perspective is fantastic.
All right, so just a couple other things, and I think
as long as we don't have idiotic, measures, or what was the
that's great. Honestly,
idiosyncratic. Is that what it was?
Yeah, it was. It's idiosyncratic, which is diversifiable risk, but candidly, a much better name for it is idiotic risk. Because if you can diversify it and you don't get compensated for it, why, or on an expected basis, you may have a luck factor, but why would you want to take it? So that's the best slippage that I can think of in a long time, buddy. So great to have you
I was
on.
able to contribute to today's episode in a positive way. Fantastic.
Yeah, I'm going to share with Michael Finca that I think he'll probably use it as well.
Oh, excellent. Excellent.
So if I go back to kind of what's been working year to date, so a couple things. So the only thing, I don't want to say the only thing, but a few things that are positive. Again, commodities are positive. Commodities are up quite a bit. So anybody that's building a home knows this. Anybody that's shopping at a grocery store, anybody that's filling up their tank, they can see this happen. Commodities are very difficult to own. They're very volatile. Candidly, they lost money for probably about 15 years. So to actually own them in your investment portfolio, candidly is very difficult for a lot of people. Even if you have a good understanding of the role that they play, it's just they're very difficult to own. So I'll kind of mention that. Leveraged loans are bank loans. So these tend to be very short duration, higher yield, a little bit riskier loans in certain environments, but those are actually a positive on a year-to-date basis. So and I think that's a good point too. Anything that has higher cash flows, could be value stocks, could be emerging market bonds, high yield bonds, leverage loans, real estate, anything with more kind of near dated cash flows, higher yielding, tend to do fairly well, or at least have held up better in the more recent period that we had than stuff that like the growth stocks, like things that have much future dated cash flows. So that's a general principle to kind of keep in mind here. And then I've talked about asset classes, but now I'm going to mention like a different strategy. So it's using a lot of the same asset classes, but the way that it's using it is different than what most people traditionally would do with these assets. And we just call this a trend following strategy. So yeah, it uses things like stocks, bonds, currencies, and commodities, but it kind of uses that crowding effect that I mentioned where, as things are kind of going up, and it's exhibiting positive momentum, kind of like a really strong trend, it will buy those things. And it's truly just kind of a price following strategy. But also on the other side, if things are going down, like bonds were going down, interest rates were going up, but bonds are going down, it's an inverse relationship. So a lot of these trend following strategies, really because the positive commodity trend and the increasing interest rate trend, said another way, the negative bond price trend, have actually delivered quite positive returns so far. So I'm just looking at like it's just from Morningstar. It's just a combination of all the US funds in the systematic trend category, and it's actually up 16.7% year to date. So that's, all those negative numbers that we mentioned. Leverage loans are up slightly positive, but that systematic trend is up quite a bit. So, and this, because it can kind of go both ways, it can own something long and follow the positive trend up, or it can own something short and follow a positive trend or the negative trend down. It tends to be non-correlated, both to stocks and bonds overall. So that's a really good kind of portfolio diversifier. It's also difficult to own and probably a little bit beyond the conversation for today, but there are different ways where you can incorporate it and probably make it easier to own. There's been different investments developed over the last several years that kind of combine it with some other strategies that candidly make it easier to own. And if you are a True Wealth client, this is something that we're going to be touching on in our client letter that we're posting here to your client vault. I would say probably the one thing I want to take away from today's conversation, in addition to kind of not losing sight of, why we're talking about this again, it's all tied back to your financial life plan and what have you. But it's really about preparing and not predicting. Sure, we may certainly favor certain assets that are more reasonably priced. We may choose not to follow the high growth stocks up into nosebleed territory where there just doesn't seem to be any legitimate fundamental reason to do so. But these changes in the market dynamic, particularly that we've seen over the last several months, they happen quickly, literally in just a matter of like several days to maybe a week. It seems like we've gone from one regime to the other, and the markets just moving so quick. So if you are, think you're smarter than the average bear and saying, well, okay, hey, I really like my high growth stock returns, but I'll just change whenever, the regime changes or something like that. Candidly, that's probably something I was said in my early 20s before I had more humility and didn't know what I didn't know as much as I do today. But it's really about preparing and not predicting. It's really about focusing on, where the risk is coming from your portfolio and trying to build more of that all-weather portfolio regardless of the regime. Just thinking beyond the traditional 60-40, trying to have some other things that are going to be in there that are particularly going to go ahead and be the ballast to your portfolio when we have, the sort of inflation and growth shocks that we've been having. You need good ingredients, but you really need that good recipe. I like to call it kind of portfolio craftsmanship. Sure, if you're building a house, you need to have good lumber, you need to have good tools, you need to have good concrete, but you better have good people that are using those tools and those materials properly to go ahead and have a quality craftsman home. Same thing when it comes to investments. And the one rub, even though all of this, and I can bore you and anybody else to death with all the kind of the empirical evidence or the science-based evidence belying all this, Walt, it's like, even though it could make sense, if you can't stick with it, it just doesn't make sense to do it. And it makes the sense to have something that's kind of optimized for you that you can stick with, that you can own. And one way that we think of this, it's really called tracking error. And it's so difficult, but when the S&P 500 and growth stocks are soaring, nobody wants diversification. They just, hey, give me that. That thing in my portfolio is doing really well. Give me more of that. That other thing, man, it's got like low returns or maybe even negative returns. Why do I want to own that? And then ultimately, the music runs out and here we are. And maybe you're down, 20, 30%, hopefully not more than that when that happens. So, it's retire smarter, it's invest smarter, it's trying to do all these things smarter, it's trying to be purposeful, trying to use science, really trying to prepare, not predict, not trying to have luck, but trying to be broadly accurate in what we're doing. It's all those things. But I think the time in the market that we're in right now, and probably going to continue to be in, all of these things are going to become much, much more important in that whole portfolio craftsmanship and just understanding and really kind of that diligence of tying things back to your financial planner become much, much more important. The Federal Reserve are probably have really impacted investment returns and asset prices over the last, 15 or so years. And they just don't seem to be able to do that given the inflation that we've been having. So it seems like a lot of the prudent planning, a lot of the prudent diversification that we need to have is likely to become much, much more important and a stable part of what we're going to need to be doing over the coming years, because a lot of the probably Fed-induced lack of volatility and asset price increases is no longer going to be the case.
When we didn't have to worry about inflation, or when it wasn't currently happening, people tried to ignore it. And when we didn't need to worry about, diversification, people were, ignoring that, just like you pointed out. And it's a good reminder that a well-balanced plan isn't just well-balanced when it's convenient for us, but needs to be kind of that way all the time. And that kind of, I feel like, resonates kind of from what you're talking about today on the show, Kevin, and kind of a good marker to take from here. So our plan needs to be properly structured all the time. Not just, when all of a sudden we're in crisis mode, then we got to prop it structurally. Do it right from the beginning and you're in good shape. So
you got it. Sorry, Walt. My 3-year-old is getting ready to go to school, and our morning routine is that she comes down and to my office. I'm working out of the house right now while we're in Florida, and she likes to show me her pretty dress. So she didn't know. And probably doesn't get it that we're recording a podcast and Daddy's talking.
She doesn't care. Why would she care about that? That's not important. Picking out the pretty dress is way more important than recording the podcast episode. So I'm glad we were able to take a quick break for that, make that happen there, Kevin. If anybody has questions about something you've heard on the show today, it might have brought up some concerns about your plan, your portfolio. Well, here's the good news. There is help available. Kevin Kroski and the fantastic team at True Wealth Design can certainly help you out. Whether you're in the Northeast Ohio area, Southwest Florida, the greater Pittsburgh area, where all the kind of local locations are, or really anywhere, they can help you remotely, of course, with today's technology and digital world. All those options are available to you to meet remotely as well. Here's the easiest way to get in touch and find out if the True Wealth Design team is a good fit for you. That'd be to go to truewealth.com truewealthdesign.com. Click on the Are We Right For You button, and that'll allow you to schedule a 15-minute call with an experienced financial advisor on the team and begin that conversation. So it's easy to schedule, easy to have that initial conversation and find out what next steps might look like, address some of those concerns that are on your mind. You can also call 855-TWD-PLAN. That's 855-TWD-PLAN. Or again, the website is truewealthdesign.com, and look for the Are We Right For You button. And we'll put that contact info in the description of today's show, so it's easy for you to find. Kevin, appreciate the help and all the guidance on the show today. Glad we triggered an egghead alert as well. And we'll have another new episode coming out in a couple of weeks with Tyler joining us, which looking forward to Tyler Emmerich joining the program to sub in for you, Kevin, so you can rest that voice a little bit. Feel better, my friend.
All right. Appreciate it, Walt. Thank you.
All right, you bet. That's Kevin Krosky. I'm Walter Storholt. We'll see you next time right back here on Retire Smarter.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.